This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
This week on the podcast, I have an extra special guest, Adam Parker. What a fascinating career. Top-ranked institutional analyst, semiconductor analyst, head of research at Sanford Bernstein, head of U.S. equities at Morgan Stanley. Really a masterclass in how to think about creating frameworks for investing, for thinking about how to apply quantitative research along with macro and fundamental data in order to create a differentiated research product. Just absolutely a masterclass in thinking about stocks and thinking about sectors and thinking about where is the crowd wrong and how to come up with a very outlier perspective, many of which have been giant moneymakers and really fascinating market calls. I found this conversation to be brilliant and insightful, and I think you will also. With no further ado, my conversation with Trivariate Research's Adam Parker.
This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
My special guest this week is Adam Parker. He is the founder of Trivariate Research. Previously, he was Global Director of Research and U.S. Equity Strategist at Sanford C. Bernstein. He was the #1 institutional investor ranked analyst in semiconductors before he became Morgan Stanley's Chief U.S. Equity Strategist and Director of Global Quant Research. Adam Parker, welcome to Bloomberg.
Thanks for having me here.
I've been looking forward to having this conversation for a while, and I have to start with your very interesting academic background. You have 3 degrees in stats, not just undergraduate at Michigan, but a Ph.D. from Boston University. And in the middle, you got a master's in biostatistics at UNC Chapel Hill. Tell us about that.
Yeah, well, back then, statistics wasn't as cool as it is now, Barry. So I didn't know 30 years ago it was going to turn into all the rage and that everyone was want to major in data science and analytics. I was always more of a math guy, and I liked having problem sets and then going and playing sports, and I didn't want to have to read Chaucer or whatever all the other miserable people were doing. So kind of motivated me to be a little bit more analytical.
But the question that raises biostatistics is, were you always planning on a career in finance, or was that?
That was more, the biostatistics department was in the School of Public Health at UNC, and it's really, applied statistics, at that age to mostly medical data. But it was more about learning analytics and, programming and
you can apply it to any
field.
You
can apply it to anything. So like my PhD thesis was about missing data in a healthcare setting, but as you know, missing data exists everywhere, including in finance. So it turned out to be pretty applicable.
So how frustrating is it to you to see either newspaper headlines or social media where people just lack a rudimentary understanding of basic statistics and probability?
I think the big challenge is, as you know, because you're good at this, is taking things that are somewhat complicated and then making them sound like they're simple and explaining them to everybody. I think the average intellect of people watching and reading mainstream media is still in the junior high or early high school level. So that's what you've got to resonate with. And I romanticize the investment community is slightly above that, but it probably is less above that than you think. Right.
So we'll talk about Trivariate a little later. I love the name.
Yeah.
I wrote a Bloomberg column years ago. Single variable analysis is for suckers or something like that. And so I have to talk to you about that name.
Of course.
But let's, with all that stat background, how did you get to Sanford C. Bernstein?
In those days, I finished my PhD in the late 90s. I had some buddies that seemed to be getting rich on Wall Street, and I didn't really know what they were doing. And one of my best friends worked at Sanford Bernstein, and they were looking for somebody to write, software and do analysis called quant research on equities. And I interviewed there, and I loved it. This bunch of crazy, wild people who were brilliant and kind of a little bit on the edge of being unhinged as human beings, and it was just kind of my jam, And so
you're so buttoned up. You don't sound like a a crazy
But it
quant.
was effort and enthusiasm, right?
Yeah.
Just like getting the Ph.D., Barry, it's basically 99% perseverance, 1% intelligence. And this was like, you get in there and there was just no rules. Like, find something interesting and write about it. And so for me, there's this database of, information on hundreds of stocks, and you could go in there and analyze it and reach conclusions. Oh, long the top market cap name and short these against it, or do this, or, just kind of empirically test everything. And there was a bunch of incredibly brilliant people there. So I loved it. I loved the environment, and I didn't even know what I was getting into, to be honest with you.
And then from quant work at Bernstein, were you an analyst in semis there also?
Yeah. So I switched to being semi. Look, at that time, big late 90s into the TMT bubble, what seemed cool to young Adam Parker was being an analyst. Oh man, these tech analysts, that seems like a great job. And Bernstein in those days, you were really an expert. You wrote 200 page black book, it was called, on an industry, and you could tear apart the P&Ls of the companies, and you really understood. We spent all our time on 6 to 10 stocks, so you really knew those companies, the management teams, the things that impacted the volatility of the P&L. You kind of became an expert, and so I really wanted to do that, and I just got lucky that it was semiconductors. I basically just kept going in saying, I want to do this, and the first sector they offered me, Barry, was European electric utilities.
Oh, that sounds like so much fun.
Yeah, and I really struggled with how I'm going to communicate to them. I'm really on board with the fact that you're allowing me to be an analyst, but I can't move to London. Yeah, that's it. I can't move to London. I just got engaged or whatever. So I enabled to sort of convince them, yes, thank you, I'm an analyst, but no, I'll wait for the first U.S. one. And it could have been anything. It could have been food. It could have been, I didn't really care. And when semiconductors
So you
came
didn't have a tech background. You didn't have an engineering, because a lot of the analysts,
all of them
covering semis,
yeah,
they're electrical
circuit designers
engineers,
from Intel.
they're
Exactly.
computer software design.
I used to, and Bernstein's hiring model back then was basically get a McKinsey guy who was an expert on the industry, or somebody who worked at one of those companies. I was one of the rare counterexamples of,
promote from within.
Yeah. I think the Ph.D. in statistics probably helped me. I used to just say, look, I'm probably better at counting the chips than knowing what they are. And it turned out that in those days, what really mattered to getting the stocks right was sort of a non-consensus and correct view of the gross margin 6 months forward. And so that didn't really require the expertise on circuit design and the like. In fact, you know this, but sometimes the people who worked at the companies turn out to be not very good at calling the stock price of the own company they worked at, because you have all kinds of biases from the people you like and you don't like and that kind of stuff. So it worked to my advantage, but I think probably wouldn't have happened if I didn't labor through that Ph.D.
So how do you get from Bernstein to Morgan Stanley?
Yeah, so after I did semis for a few years, and that's a very competitive business. You get up every day. There's a person at Merrill and a person at
everywhere.
Goldman, everywhere.
Go
you wake
the
up, they're your competitors. You want to make them look stupid on the conference calls, and you want to ask the smartest question, and you want to be number one ranked, right? So you do that, and Barry, once you get number one a few times, all you think about is like, am I going to lose it? There's no joy in repeating as number one. There's only the fear of losing it, right? Because then you've like, wait a minute, like investors don't like me as much as I used to. So, I felt like I wasn't really incrementally, doing that again wasn't going to drive me anymore. And, I was offered, this position to run research at Bernstein. And so I transitioned to be the director of research for a while, which was attracting, retaining, hiring, firing, that kind of stuff.
It's a management position, not a research
position. It got me away from that. But the beautiful part was I then was helping other analysts ramp. And so I got to learn, okay, I'm going to launch the household products guy. I'm going to launch the capital equipment guy, industrial. And so in that year, I was helping kind of 4 or 5 analysts ramp. I started realizing, like, this is kind of interesting. I can apply what I know at semis and help them. And so early in 2008, very beginning of 2008, the strategy and quant research job opened up at Bernstein. And that's how I transitioned to being a little bit more, quote unquote, macro. So I did that for a couple of years, and then I transitioned to Morgan Stanley to be the strategist there.
And for people who may not remember this, in the 90s, Bernstein's bevy of analysts were top ranked.
So in 2007, when I was a director of research at Bernstein, these are the data. Bernstein had 23 U.S. analysts that were publishing. 18 were ranked in the top 3, and 11 were number one.
That's unbelievable.
Yeah, so it was really a number one machine in terms of the analysts that worked there. And it was my job was get the 5 that weren't in the top 3 and hire a few more that will eventually be number one in the future. And then that was in the U.S. and we also were building a European business too. So
obvious after the fact question, Bernstein was substantial in size, but they weren't Goldman Sachs or Morgan Stanley, Merrill Lynch. What was the secret of success? Why were they punching so far outside of their weight class?
I think there, it was multiple things, but I'd say, you don't have a prime brokerage business, you don't have a banking business, so there was this perception of independence. You hire people who were, generally were, experts in the industry. I was an exception, but there were generally people who were running the McKinsey practice consulting the aerospace companies, and they would be hired to cover Boeing or those kind of things. So kind of the industry knowledge, and I think the buy side, relied on that as sort of an external voice. When you interview the buy side, they tend to not care if the sell side are good stock pickers or not. They might blame them if they're bad, but they're never going to say, I rely on the sell side for their stock selection skills. That's what they're supposed to be doing. So I think what helped Bernstein gain prominence was the fact that, all right, we don't even try to do that at an expert level, just try to help people be smarter about the investment controversies and write detailed sensible issues on those investment controversies. So that was the business model, and it really worked back through, and at least until maybe 10 years ago.
So you raised such a fascinating question I want to ask you about, and we're recording this late April after Netflix, which had fallen 50% from its October peak. At their earnings call, they announce a decrease in subscribers. The stock falls another 27% overnight. The next day, there are all these downgrades from the major sell-side shops. Cut to neutral, cut to hold, and it raises the question, and I'm sure lay people ask this question to themselves all the time. Hey, the stock is now down 75% from where you told me to buy it. What's the point of this downgrade? Thanks for nothing.
Yeah, I mean, the sell side...
defend the entire analyst community. Go.
Okay, yeah. When I got to Morgan Stanley I'll answer it this way. When I got to Morgan Stanley in the late fall of 2010, I wondered if the research department there generated any alpha with the recommendations. And so I analyzed, they had stored data from 03 to 10. There was about 3,500 stock recommendations that were kind of stored. So... I
let the statistician loose on the data.
Yeah.
And
so
what'd you find?
About half were overweight rated, half were equal and underweight. So I thought, all right, did the overweights beat the equal and underweights? Your exact question I considered. So I didn't. Stocks down 25% in the aftermarket, and then they downgraded. You do not give them credit for that being a correct call. You lag it by 24 hours. You beta adjust it, meaning adjust for how much the market moved. And it turned out, at least for the 3,500 observations over 7 years, that they had about 4% average alpha between the overweights and equal and underweights. So I published that as a bar, 4%.
So in other words, the stocks they liked did 4% better than the stocks they didn't like.
And then,
but how did it do versus basic indexing?
Yeah, well, that was kind of a market neutral, right? So like your overweight longs and your short the equal and underweights. And then I had a quant model that, the long top quintile beat the bottom by 9%. So I sort of said, look, I think quantitative stuff probably, is a little bit better than fundamental stuff. But then the last bar was 13%, which was if you only bought the overweight rated stocks that the model liked and you only sort of shorted the equal and underweights the model didn't like, you get 13. So the whole point of this was a combination of something quantitative and maybe unemotional combined with the fundamentals would be superior to either discipline alone. And actually, I've spent most of my life since then, the last 12 years in that sort of combination sphere. So I think I'm trying to defend it by saying, look, I think there's some value in it for sure, but there's not value in changing the recommendation after it's happened. My own personal opinion on Netflix, and I'm not a fundamental analyst there, but I did write about it, Barry. It's interesting. I've had two learning lessons that this one applied to. One, when things change, you have to admit it. And this one, I think, has both macro and micro changes. I think the macro would be, everyone bought too many streaming services during COVID and maybe doesn't need as many.
Now they're out of their house again.
Right. And so it's reopening. And the micro is they've got to think about pricing and maybe charging people or not charging them for advertisement. So that's kind of a business model change. And the other thing, so maybe you have to say to yourself, well, it's not exactly the same fundamentally. Maybe, sometimes I guess I'd answer your question by saying sometimes the stock's down 25, but the fundamentals are worse than 25%. Right. And that, maybe not in this case, but I'm saying in aggregate. And the second learning lesson I've had from analyzing a lot of behavior on the short selling side and running my own fund is you make more money shorting stocks down from highs than you do at highs.
Right.
So it's very tough to short stock at a high because you're fighting positive price momentum.
Don't fight the tape.
Right. So when the stock's down 20% and then you short it, I guarantee you make more money shorting stocks down 20 from highs than you do at highs. So it's not necessarily true that Netflix isn't a short here, but I'm not a fundamental analyst. But I'd say in that case, I'm not convinced that It isn't worse. It still trades at 100 times forward free cash flow. It's got a high correlation to low quality and work from home. It's got a high correlation to negative correlation to inflation. So I don't know if growth, stocks like that are going to work. So I don't know the fundamentals that well.
And one of my favorite things about having you, who is an independent research shop instead of a sell side analyst, I'm not getting a phone call tomorrow from the PR person begging me to take everything Adam said out about Netflix.
No,
he can't talk about that.
Zero
you
chance.
Can talk. You go anywhere. You could talk about anything.
That's right.
Without restriction. So that leads to another question. How freeing is that you can actually say what's on your mind and you're not thinking about what, obviously legal is important, but sometimes compliance gets a little overenthusiastic and PR even more so.
I would say, I should look this up. So this is an exaggeration, but I would say,
look at you hedging already.
I would say maybe 10 years ago when I worked at Morgan Stanley, I think there was 50,000 employees and 10,000 in legal and compliance and 10,000 in IT. So those are slight
40%.
Yeah, but that's something like that. So look, these are amazing firms. And Morgan Stanley is an incredible firm with great people, and a lot of whom I'm close with. But what I'd say is that there's positive and negative. The big firms have bigness disease, and the taxes on your time become substantial, right? You need a bunch of videos to money laundering, and a bunch of, every firm has this,
right.
Compliance stuff. You got a bunch of 360 feedback, MD and ED promotion, ESG, diversity and inclusion. The number of things you have to do just to...
Time tax is a great way
time
to
tax,
describe
it's a huge tax. And so for me, it's very freeing. We're not a broker-dealer. Our whole job is to write, interesting research that makes people think. We sell data. We, create baskets. We do a lot of outsourced sort of chief risk officer work where we sign non-disclosure agreements. People send us their portfolios, and we kind of analyze them and try to give them some interesting thoughts about it that aren't in, Axioma or, things they can get from other vendors. So it's really freeing. It's really freeing. But, you don't have the resources. You don't get first class to Beijing either. So there's some positives and negatives.
Wait, you're flying commercial? Come on.
I always fly commercial, man.
So let's talk semis. They've been driving everything from the shortage of automobiles to inflation. Mm-hmm. Give us the broad overview from your perspective.
Yeah, well, one of the things that is tricky when you're an investor, Barry, is what is cyclical and what's structural, and you can confuse yourself when something's cyclical when you think it isn't, and when the periodicity changes and those kind of things. So,
I love all this mathy talk.
Amplitude, periodicity.
I'm so excited. I'm back in college.
I think what you said is right, though, that they're kind of an important barometer for a lot of broader issues. The two things that I'm tracking right now really carefully are a concept called book to bill, which is sort of how much revenue did you ship out versus what does your order flow look like, and is the order flow higher than you shipped out, book to bill ratio. Generally, that's still above 1 for most semiconductor companies, meaning future demand looks a little bit better than trailing demand. But that book to bill ratio has come down from maybe 1.15 to 1.08 to 1.06. So
come down due to the supply
as
coming
we
online?
finally get supply catching up post COVID. I think when that, if you think about it, it's a weird way to think about it, but there's probably only 1 second where production equals consumption, and then you're either about to start overproducing consumption or you're about to start underproducing. So I think we'll get to equilibrium in the second half of this year in most parts of the semiconductors.
Wow, that would be a huge windfall for
the supply,
anybody who wants to go out and buy cars.
Yeah, I think that's right, and I think the second thing that's important related to that is backlog. So, one of the things that I think Bernstein was good about, is making you think like you're the CEO as an analyst. So think like you're CEO. Step into the thought process that you're running the company. So if you're the CEO of any industrial company, auto, home appliance, any real business, you've had trouble selling product in the last 18 months because you couldn't get the supplies you need. So you go to your procurement officer and you say, "Yo, how about stop bottlenecking my final revenue?" So what does that person do? It calls the semiconductor supply chain. It says, "I want 200 million 18 months from now. I want 200 million 12 months from now. And by the way, I want 200 million 24 months from now." And you start piling on the backlog so that they know, hey, I'm going to be there and I'll be there for a while. Ramp it up, right? And so that has some interesting contagion in the economy, right? Because these guys start planning their their capacity as if that backlog is going to be there. One of the very weird parts about the semiconductor industry that I don't think everyone understands is there's zero penalty for backlog cancellation. So you and I can, if we want to go to Nobu for sushi, we're going to pay $25 if we cancel our reservation, but somehow I can order 200 million of silicon and have zero penalty. It's very strange, right? So if you get any whiff that backlog's got air in it, meaning, when we get production equaling consumption, probably you're going to call some of them like, you know what, I'm probably only good for 100 million 18 months from now. I don't need the 200 million.
And there's zero consequence.
Zero penalty, right? And so I think that's a key. That's why I think backlog and book-to-bill are really important to watch. And if you get any whiff that some of the backlog is not real, I think that causes fear. Now, we've seen semis come in a lot here because I think people know they're over-earning and they can see, where we are 6 months from now. And so now I think you're at the point where you're going to pick winners from losers a little bit more. As you can imagine, some of semiconductor business does not have perishable pricing. So the cancellation, they have inventory, but they don't have to cut the prices. So the Texas Instruments and Analog Devices of the world, their products really aren't perishable. Whereas, some of the microprocessors that Intel and AMD make, or graphic processors that Nvidia and AMD make, or, obviously Micron with memory, like that stuff's super perishable, right? So if they make excess, the pricing comes down a lot. So you'll start getting a little, discriminating between winners and losers a little bit more in that sector. But I think the broad tenor of your question, Barry, is backlog and book-to-bill are probably, in the top 10 interesting, more macro barometers for people to focus on.
So from a macro perspective, one of the most interesting questions that comes up over and over again is, why does it seem to take so long to reopen a semiconductor fab after a prolonged shutdown?
It's a number of issues, but you may have excess capacity in a factory, but it may take you several weeks to start building it and ramping it up. You may have tools that are idled. You may have tools that are not assembled yet, right? So you can't really turn on a dime your production as rapidly as people think. It is a lot more automated now than it used to be, though, in terms of how it works inside a wafer fabrication
Not
facility.
People in bunny suits moving
right. So
big
I've been
wafers around.
Exactly. So you and I are the same vintage. So I've been in the bunny suit in the old factories, and if you think about, they used to talk a lot about yield. And some of the yield was just like people's hair getting in the stuff, or dropping these things on the floor. And so that's
triple ventilated. You're going through multiple clean rooms to get into.
Exactly. Now it's all synopsis and cadence and software, and the stuff goes on the ceiling on tracks and comes down to the right machine. And I don't know if people can mentally imagine a wafer fabrication facility, but they're like the size of a football field, and there's $10 million machines as far as you can see in every direction. So it's multiple billions of dollars. I think when I went to, it's been many years now since I covered semis, but when I went to one of their state-of-the-art fabs at Intel in Oregon many years ago, they had a sign out front saying they had more steel than 2 Eiffel Towers and enough cement to go to Portland, from Portland to Seattle.
Wow.
Like, they're big facilities. So I think it's just not as easy to like quickly ramp up a bunch of the capacity as people think.
So that raises a question that a lot of people have been asking, which is, how seriously can we reshore manufacturing facilities in the U.S.? Is that a real thing, or is that something that the politicians wave their hands about? But it's so much money and it's so much cheaper overseas, it's not going to happen. I
think there's a lot of things that could change. That deglobalization theme, I think, is real. If I think about what's kind of changed pre-COVID to now, probably the deglobalization theme you're talking about is one of the bigger actual changes. You don't need to package and test every chip in Taiwan. There's some cheap areas here in the U.S., and I think that's structurally changed. I know Intel's announced some massive, $100 billion CapEx plan over multiple years to build some stuff in Arizona and other places. So I think we're going to onshore more of the manufacturing. And I think that part's real.
Right. There's a national security issue.
Yeah,
with having
security as well.
China make the chips for our F-22 fighters is potentially.
Yeah. And I think there's also there's been diminishing benefits to outsourcing it on the cost front as well. Mm-hmm. Now, maybe that doesn't mean, I don't know if that means Intel's going to be a good stock, right? Just because they're going to spend all that CapEx doesn't mean it'll be good for the shares.
Let's talk about Intel. They've been criticized for a lack of innovation, for not keeping up with the Nvidias of the world, or even with Apple and their M1 chips. I by the way, footnote, I got a new iMac in December, and the old machine is 2 years old. The new one is like 6 times faster. It's insane, the difference between the M1 chip and the solid state, no spinning drives, nothing.
Right.
So what happened to Intel? How did they seem to fall so far behind?
Yeah, it's a good question. I mean, I did a research note recently on capital spending and R&D. It's in sort of R&D intensity and capital spending intensity, meaning relative to sales, changes in that, what it means for subsequent returns. And our work shows that Intel's been one of the biggest destroyers of shareholder value of any company in the last 20 years because they spend, tens and tens of billions on this stuff, and it hasn't really made their stock go up.
Right.
So if you think about it,
has it helped their sales, their revenues?
Yes, but we don't really care. Like, we're stock guys. Like, I don't I want to buy a stock that goes up. I don't really care if their revenue goes up and the stock doesn't. So the stock's gotten cheaper,
right?
And they've lost share in major areas. So I think that that it may be, I don't want to say fruitless, but it may not be a high return on the investment, but maybe it's just good for America. And there seems to be bipartisan support for that as well.
So let's talk about a stock whose price has gone up. Probably the hottest semi for years now is Nvidia. Tell us why their graphics engine is just kicking everybody else's butt.
They did a lot of stuff right. I mean, I dropped coverage of semiconductors, a dozen, more than 15 years ago, actually. January of 7.
So now you're as up to date as I am.
Yeah. And I'm in like the danger zone of thinking I know stuff that's no longer relevant.
Today on Dunning-Kruger Presents.
Yeah, exactly.
Adam Parker on semiconductors.
Yeah, so I can tell you about, high school in 1987 also. But, I think that some of us who have been around the block, probably missed at least the first half of Nvidia because we didn't trust the management team. And I think a combination of lucky and brilliant, not all brilliant, but graphics and crypto, and they got into a bunch of other things that really
right
worked.
Space, right time,
and so it's been a monster. Now it's been reset a lot because the valuation was high, and so I think people realize that these businesses, back to my original comments, the slope has been upward, but they're also over earning at the same time, and so that's why the stocks have come in so much. I think it's probably still a little bit too early. But I think as we get closer to the production line of consumption and the stock's correct, maybe it's time to get in again. And the world needs semis. You can't really produce anything without them. So I'm kind of a long-term bull, but kind of short to medium term, just feel like this correction needs to, happen.
So let's start talking about you sitting on the investment committee at Morgan Stanley, which is about $2 trillion in client assets. I don't know if it was that when you were there.
Yeah, I think when I was there it was 2. Who knows with this E-Trade thing? It might be 3. I have no idea. I haven't caught up with it.
That's a lot of wood. Tell us what it's like to be responsible for that much money.
Look, there was a 7-person committee. Everyone on there was...
Hey, 1/7 of $2 trillion is still a lot of money.
Yeah.
A lot of capital.
Yeah, I don't know how much of that I felt responsible for. I was the equity guy. There were bond experts. There were international experts and alternatives experts. But fortunately, I was there during a period where
straight up.
Yeah, I just sort of said, look, you guys can own whatever you think makes sense, but I'll take 20 U.S. growth stocks and I'll meet you in 5 years, and basically that worked. So I can look back and say I generally gave good investment advice because I just felt like we were in buy the dip mode. It was pretty clear that U.S. equities look better than other asset classes. I generally think that still, Barry, which is that I'm getting a 2.5% net buyback plus dividend. I get some organic earnings growth of a few percent. So I think the U.S. equity market looks like a 6 to 8% total return algorithm.
Normal.
Normal, and that looks a lot better than most of these other things. And I never really understood the case for owning. I mean, I got a little bit in trouble back in the day at Morgan Stanley when I would say stuff like Europe is great for vacation, but not for stocks.
Which has, by the way, turned out to be exactly true for a decade.
Yeah, and we had a 2-year period where it hasn't been good for vacation, but I think it will be again this summer. But I think generally that's been right. And so I don't, I felt like it's important to hit on the importance of U.S. equities. But I don't really know. Today I think the problem would be different and more complex. I think, recently you've seen in the news Fidelity say they're going to offer crypto for retirement plans, and there's other, there's other kind of diversifying things happening, and I think alternatives. People have a different view now than they did 5-6 years ago. Meaning, maybe people now realize that some of private equity was a levered rates call, and so the private markets have been a little bit more richly valued before they come public. It's been some evolution in the last 5-6 years since I've been doing that, but generally I think I felt responsible for making clear that U.S. equities had a pretty important and big place in the portfolio. And I think, as better than me, much better than me, how rich you are to start out with really impacts the proper allocation.
Of course. The question is, are you trying to create wealth or preserve wealth? Right. And that makes a big difference.
Huge.
So I want to get a sense of what it's like to be on a committee responsible not for $2 or $3 billion, but for $7 trillion. Is it all 30,000-foot macro view, or does it get more granular? Do you dig into sectors, stocks? How specific does that committee get?
I think for me, I've always been more about the industries, the sectors, the microstructure of the market, and it was hard for me because I had to get higher level. Because, as you're pointing out correctly, people were just trying to get the mix of equities and bonds correct, the mix of U.S. versus non-U.S. correct. I don't remember how much of that money's qualified for alternatives, but that stuff obviously has a bit of a different flavor to it. So it was pretty high level stuff. I'm not an economist, so I didn't really get into that. There are definitely some other fixed income people who focused on that. So I think generally, at least in the last decade, most people thought rates were going to back up, and they've been wrong until the last 6 or 9 months.
Right.
So again, there was sort of pretty easy to like equities over bonds.
Yeah, say at the very least. So let's talk a little bit about Trivariate.
Yeah.
Starting with, I love the name. Tell us what it means and how you came about it.
It's totally a self-serving name. So look, I was a number one ranked analyst. I have a Ph.D. in statistics, and then I did strategy. So I feel like the 3 buckets of investing, the 3 variables of investing, quant, fundamental, and macro. So when I started a hedge fund, I called it Trivariate Capital, just thinking that, I'll go tell allocators that I'm kind of considering quantitative things and macro things and fundamental things as part of my investment discipline. And we ran money at Trivariate Capital for a while. It closed it down and converted it to a research firm in the middle of 2021, and just kept the name. I had a fancy logo that looks amazing, so I didn't want to repay for a new logo. But I think we're approaching equities from the lens of systematic or quantitative, some fundamental work, and then macro. Macro is more about where are we and what to do about it. Meaning, where do we think we can pick stocks better or worse? Where should we be able to generate more alpha? Which parts of the market? Should we be able to do that right now based on the conditions that exist? So we're not doing macro from the standpoint of forecasting rates or dollar or oil, but more recognizing where we are and saying, okay, in this regime, we ought to be able to pick winners from losers very well within the industrial sector, but maybe not so well in durables or things like that. So we're looking at those 3 lenses to try to help people who care about equities make money.
So let's talk about the concept of outsourced Chief Risk Officer. Tell us a little bit about what you do in helping firms manage their risk profiles.
So when I left Morgan Stanley, I left the sell side. I went to work at a large hedge fund, and part of my role there was to be much more analytically rigorous around risk management. And then also diagnose trades to look for patterns of behavior and the like. So I brought that sort of risk framework into running my own hedge fund, and we have used that infrastructure now in the research role to help firms. So I think we signed, 20-something non-disclosure agreements where firms, they send us their portfolio. We put it through our framework, and I think they view me as sort of like an outsourced chief risk officer, where we'll talk to them through things that are not things they can get from the standard risk vendors. So things like idiosyncratic risk. So maybe they differ for your longs versus your shorts. So you're a bottom stock picker, but your longs are pretty macro and your shorts are pretty company specific. Or, as you know, Barry, like if risk didn't change, anyone could do risk management. So most people know their growth value, they're large, small, they're So we have in the last 2 or 3 years, think about what's changed. We created a work from home basket and a reopening basket, and we look at every stock's correlation to low quality work from home, like Netflix, or a high quality reopening or whatever, and we kind of see, are you offsides on your long short book on those things, or even on the long versus the index, or if you're long
short
only.
Netflix, long airlines, is that the
stuff like that. Yeah. Or you can see if they're offsides because they may not realize they have that bet on as much as they do.
Meaning they're unaware of the correlations?
Maybe unaware of the correlations, maybe unaware that they've got where the real risks are. So what happens when you run a fund is, let's say you decide, all right, I'm a little bit nervous about my tech exposure a few months ago. They're expensive and we're worried rates are going to rise, so I'm going to sell it. So I think in practice what happens is the CIO goes to some of the analysts or PMs and say, yo, give me your least 2 or 3 favorite tech names. I'm going to trim those out. Right? And you trim them out, you sell 600 pips of tech, and okay, great, I'm proactive, I got the call right. But it may not be that those names you trimmed were the risky ones.
Gotcha.
Right? So it's about, so we think about it more from the risk standpoint as much as the exposure. And there's a lot of that goes in there. So when we do our work, it's a lot of, every single name's exposure to size, substance, style, dollar, rates, spreads, oil, momentum, beta.
So this is a lot
quality,
more than
reopening,
just beta. This
ownership. We look at filing data from 60 hedge funds that we track to do deep fundamental research, and we say, does anybody here have high conviction in the name? Do they own 3% or more of their assets in the name? How does it differ from the broader population of funds? Is there good and bad crowding going on? I mean, it's a very kind of differentiated system to try to really help people understand, what the true risks of their portfolio are. We take the portfolio and we say, how did this act in the last 10 downturns of 10% or more? Where is it different today versus that? So maybe you have names that you think are defensive. You own Oracle and you own Walmart because you think they're defensive, but they get much more correlated in downturns than they look like in a steady state, or all those kind of things that try to help people think through the risks of their portfolio. So, I think we're good at that. We do a lot of like hedge baskets. So you got a big long position. You want to take out some of the kind of macro risk of it, so we can create a basket to help you hedge it. So we do a lot of that kind of risk work to help funds think through. And I think for us, it's great because I think people say, all right, well, I can hire Trivariate and they can, help me once a quarter think through this stuff or at big inflections, and I don't need to, build a team here to do that same thing.
Really interesting. So
it's fun work too.
I was going to ask, I know back in the days when you were at Morgan Stanley, you were traveling more than half the year, and I was away for 2 days, and I'm completely disoriented, and it takes a while to get my feet under me again. I'm curious if you find now that you're not doing that sort of traveling, do you have the time to step back and think deep thoughts and really organize how you're looking at the world, not from airports and hotels? How does that affect how you think?
So, probably the smartest person I ever worked with was a guy named Marty Leibowitz, Marty's an amazing human being in his early to mid 80s, is the most published person in the history of financial journals. Worked, I think, with Mr. Bloomberg at Solomon back in the day. And so just very connected and brilliant guy. And I think his wife is a brain scientist. And we went to dinner together with our wives. And I told his wife at dinner that I spend 5 to 10 minutes a day thinking. This is when I worked at Morgan Stanley. And she almost started crying about how depressed of a level of thinking I was able to do. And so all the thinking I had to do was 5:30 in the morning to 7 in the morning, and then 7 at night on and the weekends, which was fine, but it wasn't, it's system. It's an amazing firm, but it's traveling everywhere and getting fat and all that stuff. So I think it's freeing from the standpoint of, a lot of that was just, you're flying to conferences all around the world and it's a lot of airplane time. I'm traveling some now, but it's definitely more like 1 week a month, 5, 6 days a year to see, clients and potential clients. And I find that great because you want the human connection. Obviously, I'm glad the world's reopening such that people are doing in-person meetings. So you want to do meetings to talk to investors. What you don't want to do is, fly to Jakarta for one hour speech on U.S. equities.
Turn around and fly back.
Turn on, fly back, or whatever. Yeah. So I think the answer to your question is, I'm thinking more. I'm talking to investors more often, and I'm doing less, kind of push, meaning presentation of my material. So a lot of those conferences, Barry, were sector conferences. We got a TMT conference in San Francisco. The first thing of the conference will be, I talk about U.S. equities, my view of tech, and the analysts will pitch their ideas, and then I move on, right? So there's no push like that now. I'll write about tech because there's a big sell-off, and I want to evaluate what signals and stocks work after the sell-off, or it's margin expansion and cash flow, or I'll look at FANG-M as a risk factor and say, should you really deviate from that, or where should so we'll do it where it's timely and relevant, not just because there's a conference every March in Timbuktu or whatever.
But it's fascinating that your job essentially is to think at both places. But you could be the smartest guy in the world if you're constantly running. You don't have a moment to. Yeah,
you don't. But look, in fairness, I had like 9 people in New York and 5 people in India on my team when I was at Morgan Stanley, and we do not, we're not doing that now.
It's not for lack of brain power. Yeah. It's you as the
head
guy.
My own personal time.
Yeah.
It was my own personal segmentation, but the team had a lot of smart people working hard at Morgan Stanley, and we've got 5 total people at Trivariate, so we're keeping it tight, and that's because the gating factor is my time, and I want to be involved in what we're writing and doing. So
for sure.
Yeah.
So let's talk a little bit about what's going on in the market today. Sure. Everything more or less seemed to have peaked back in October of 2021, and people are freaking out about how this market is a bear and how terrible it is. What are we? 8, 9, 10% from the peak. That's barely a drawdown. What's going on in U.S. equities today?
Yeah, I think that the sentiment feels worse because a lot of people over-index toward growth in the previous few years, and a lot of the growth stocks are down 40, 50, 60, 70% if you're in biotech or software. So I think the headline number is probably less painful than some of the underlying carnage, and I think that explains that disconnect between your high-level point and sentiment. Generally, I think I would describe the last 6 months as huge change in the perception about interest rates into a growth scare, and then we got a war. So that's probably the cocktail that sort of caused the reset. My own personal opinion is that the perception about rates has gotten too hawkish, and that they're unlikely to raise rates as much as is now in the price. But I don't know that for sure. But I only say that because as we talk about semiconductors and other parts of the market, it's unclear to me that raising rates will expedite any of the supply-demand imbalances and cause, if you have a wheat shortage, I don't think you want to crush demand for wheat to the point you get equilibrium. I think you're just going to have to live with wheat pricing gaining share from something else, right? So I'm not sure the Fed, I've taken the view that the Fed are the smart ones, and so therefore they're not going to purposely create a recession.
That seems to be becoming more and more of a consensus, and I thought it was an outlier view. Hey, the Fed wants to get off zero and sort of normalize rates, but do we really think they're going to tighten until there's a recession in order to fight inflation that is not interest rate based? And I know you're not an economist.
Right.
Neither am I.
It seems illogical that they do that. So
right? How is raising rates going to affect wheat shortages, semiconductor shortages,
temporary labor
right.
problems that you can't clean hotels, all those things. So I don't think it will, and I think they'll realize that and move a little bit more gingerly on the path. And so maybe the path will be last longer, which is fine. I think the U.S. consumer's in good shape. We did a lot of research on that this year. I think the earnings season,
households are strong, right?
Yeah, the earnings season in April, if you really look at bank earnings and the comments from them, Master Trust credit card data, 30-day delinquencies went down, 90-day delinquencies are at an all-time low, retail sales, consumer confidence, wages, jobs, everything looks fairly good for the consumer. So I'm not saying it couldn't slow materially in 6 months with higher oil at the pump and the like, but I still see the U.S. consumer in pretty good shape. And so underneath that, for me, like what I focus on is, all right, what's like a long and what's a short? Wow, like growth staples are incredibly expensive, and yet like the value discretionary stocks look cheap, and so maybe I can long some and short the others, or So I think there's a lot. Like I'm excited about the long short opportunity within the equity market, independent of what the Fed does here. But if you ask me like what I think is like where there's the most excess capacity in the financial industry, in an industry with massive excess capacity in every single area of it, I would say the number of people who watch the Fed and memorize everything they do and have no idea what they're actually going to do and are never right. That's where the excess capacity exists.
Short Fed watchers.
Oh my God, I would short hockey rinks of Fed watchers.
I'm with you on that. So let's talk about a couple of sectors.
Yeah.
Oil and gas, been a huge outperformer.
Yeah.
Does this continue? What do you look at? How do you evaluate oil and gas when you have the wild card of the war and the big booming reopening?
Fortunately for us, and I'm not like trying to break my own arm, patting myself on the back, but that's been our biggest, call since we started the firm a year ago, is to be over. It's
been a great call.
Under energy, yeah. And
that's why I asked you that question.
Thanks, man. I mean, I can only hit the Etfs pitch. You start spinning it with me, and I'll be in trouble. No, for me, look, I think it's really hard to forecast oil. So what I would back up and say, what attracted me to it was what I call the triple crown of quant. Upward earnings revisions, positive price momentum, cheap valuation versus history. So I have those three. You start digging in and you say, okay, well, let's go talk about it with investors, right? And investors gave me two sources of pushback, right? One is, hey, they don't say it this way, but hey, Adam, like the specter of us gathering assets under this thing called ESG is far too great for us to, risk
Even
whatever,
on the
alpha.
buy side, really?
Yeah, the bigger firms, I think that's the case.
Huh.
And then, and there's a few of those that might be the case for. And then the second group, I'm going to say is more in the, hey, Adam, the terminal value of oil is zero. And that's the part where I really start getting, kind of aggressive.
So they're unfamiliar with material science and plastics.
Well,
There's an old joke about the Saudi prince who said to the American oil company, I can't believe you guys burn this stuff.
Yeah, totally. So I'm smiling because, as I push the thesis, I think a lot of people just say, look, I don't disagree that I think peak oil demand from the experts, it looks like 2032, something plus or minus,
sure.
Right? 16% of new vehicle sales are either electric or hybrid. The install base is 8%. Cars are born and then they die. There's no in-between state. So it's a lot of new car sales you need to get the install base.
And today last a decade or
12 years or whatever, right? So I don't see any way peak oil demand isn't in the next 10 years. Okay, and remember, we live in our cozy lives here, but 500 million Indians still defecate in the street, and 3 billion people don't have air conditioning, and it's not like when it's hot out, and you've experienced air conditioning, you decide, for the sake of humankind, I'm not going to AC my place. So the demand is going to be longer tailed than people think. As
right.
Toilets are good, and AC is good, and Wi-Fi is good, and electricity is good, and so oil consumption, the people who have been the most protesting, the terminal value of zero argument are people who fly private and have 19 houses. Their own oil footprint's massive. So I don't understand where that disconnect is. And sure, maybe there's a pharmaceutical patent cliff where I pay lower multiples for oil as I get 5 years away from that peak or whatever. I get how stocks work, but it seems awfully early if there's E&Ps with 25% free cash flow yield to get too negative. So I started getting aware its sentiment's negative. And then
which is bullish as hell.
Bullish, really bullish. And if you look at how a lot of funds work, we did a note last year in June 21 called Esg Etfs, 49% QQQ, 49% XPS, SPX, 2% ESG. So the idea was these things are closet triple Qs. Now that energy has beaten the Qs by 50% plus in the last 6 months, we've heard a lot of firms say, well, we're thinking about switching from a sustainability level to buy a stock to a change in sustainability score, meaning if they're improving on the sustainability front, maybe we can buy it, because you can't handle, everyone's cool to buy ESG stocks when they're outperforming because they're on the Qs, but when they lag by 50, it's less cool. Right. So I think you could have a flows thing that's positive for this group also. And I know a lot of smart people directly investing in resources and the like. You throw this Ukraine thing on, I'd say the one thing, and you mentioned it earlier, and I agree with it. I can't help but say, I'm talking about markets when there's massive and horrible human implications, and it's almost like you feel awful doing that. But you have to mentally separate for this and just say, okay, well, sure, if we get any announcement of a ceasefire or that Ukraine's winning, oil stocks are going to go down 10-15% in a minute, right? We get that. But I think I'm more in the buy the dip mode, believing that demand growth will exceed supply growth, sentiment's negative, they're cheap, upper revisions, positive momentum, than I am it's the end of the day. So I think it's a pretty bullish setup for a couple year view, and it's not just a short-term trade.
So you mentioned something that I'm kind of fascinated about. There's been a lot of pushback on ESG, and there's certainly been a lot of pushback on low carbon. Here's my beef with the low carbon portfolio. Wait, you're going to take the S&P 500 and you're going to remove all the carbon producers, but you're going to still invest in all the carbon consumers. It's the demand that's leading to these people producing carbon. How does it make rational sense? Well, we're not going to buy oil or natural gas or coal companies, but we will buy all the companies that consume those products.
Yeah, it's even more than that. I hear you, and it's even more than that, which is the solar and wind companies consume more energy than anything else, right? I mean, just
in what way?
The plastics required to make the wind turbines and move them around, and the producing.
Yeah, but that's true for any new factory you generate.
Right.
Coal, even a coal-fired.
Right.
It takes X number of years before they're net energy neutral.
Right. I don't know if it makes sense from the planet's perspective to long solar and wind and short energy as a
investment strategy.
Yeah, investment strategy. I don't think that makes any sense, to be honest with you. So
there's a fascinating article in this week's Business Week about the rise of wind generation throughout all these supposedly red states because when you look at Oklahoma and Texas and you look at the Midwest where there's a ton of natural and fairly consistent geothermal movement, the wind and all this farmland,
right.
the wind farms are giant moneymakers for these landowners.
Right.
It's just just out of left field.
I don't know if it is for the people who produce the actual turbines and move them there, though.
You would think GE Capital, who was funding these, and GE Wind Power, that should be a giant home run business, and yet it doesn't seem to be.
Yeah. Well, I think the tenor of your question I agree with, which is, and it's kind of my point too, which is I just don't think you can destroy demand. Right. Like my point about air conditioning or,
look at the entire movement to the Sun Belt. That's because of air conditioning. But no air conditioning.
And there's hundreds of millions of people on Earth like this. It turns out that like a toilet's better than a non-toilet. It turns out that
plumbing.
Turns out a BMW is better than a rickshaw. And I mean, just go down the line. So like so it's going to take a long time to destroy demand for oil. Mm-hmm. And
so peak oil,
it's at least 10 years from now,
at the very least, and maybe 20 years from now. Yeah, and
like maybe longer than Facebook exists, or or whatever, because there'll be something else cool. I'm not making a fundamental short thesis on Facebook. I'm just saying, like, people talk about the terminal value for oil, so I won't own the stocks. I'm like, the terminal value for Facebook is probably oil will last longer than Facebook, I would bet.
Interesting. Really interesting. Last question before we get to our favorite questions. We are about to ramp up earnings season. How does earnings season play into the sort of research you do? How do your clients look at it? And how do you incorporate new data from the key companies into your models?
Look, it's massive. So what we do is every day for the top 3,000 U.S. equities, we download about 500 pieces of information and compute about 500 more. And then we store that every day back for 25 plus years. So anytime somebody asks us a question, we can empirically test the distribution of subsequent returns. So, hey, what happens when this happens? We go look and study it. So earnings is huge for us because we're getting balance sheet, income statement, cash flow, ratings changes, the analyst downgrades, insider buying and selling, transactions holding. There's tons of stuff that's happening every day. And so it changes, relative valuations and growth expectations and the like. So for us, that's huge. It also, we have quantitative models that predict subsequent stock performance, and the quant models use and ingest a lot of this data to inform the forecast. So, my view of systematic stuff has always been that I romanticize something about the reported P&L of the company matters to its ultimate value. For the listeners, I think 30% of all money traded is 2 to 5 day holding period on price and liquidity. So it's not, 10 Ks and Qs being processed. For us, that's a big part of what we do. Income statement, cash flow, balance sheet, et cetera.
That sounds like an inefficiency that a third of the market isn't paying attention to the fundamentals.
Well, yeah, I think it's even more than that. That's just 2 to 5 day holding period. I think the guys who are doing microsecond and stuff are a decent chunk of volume too.
Right.
So I'm not saying there aren't plenty of really successful people to do that. I've just personally never been intellectually interested in that. And I think what I've learned so far is that you're like going to probably be better at something you like doing than you don't. And so it doesn't really appeal to me to do that. I think you can only compete when you have the tech. You need billions of dollars of tech to be able to compete in the microsecond space. And I think 2 to 5 day holding is just price liquidity, right? Access to borrow, access to risk, anonymity, other stuff that really isn't about what we do. What we do is try to find big dislocations and opportunities like energy or metals, or when we go into each sector or industry, where do we see interesting long short opportunities. So that has to come from earnings season and the updates there. And I think one of the things I've learned is like, you don't anchor, right? Like you get, like we talked about Netflix, like they told you the business model's changing. Like that's not nothing. Maybe the stock's down too much, maybe it isn't. I don't know. The fundamental analyst could decide. But what I know is that it changed.
So let's stay with that again, and let's look at technology where there is some dislocations. Yeah. We're recording this before Apple reports, before Microsoft reports. So how do you look at the entire sector? Is it uniform, or can you really segment it? Winners, losers, riskier, valuation? What's the spectrum like in that space, which has been clearly driving the market for the past decade?
So look, we're more in the, kind of maybe bucketing it too much. But when you think about earnings season, a lot of things happen. Okay, did they beat on earnings? Did they beat on margins? Did they beat on revenue? Did they guide to a change in earnings, margins, and revenue? Did the stock T+1, T+3 go up or down relative to the market, relative to the peer group? Did the implied guidance change? Because maybe they beat the quarter, didn't change the annual guidance, but the implied guidance is different, right? So there's 38 things that happen. They report whether you realize it or not. Bloomberg's great at, here's the, what happened on revenue versus what the consensus they beat or not. But there's 18 things underneath that happened. What about the cash flow versus the earnings? Was there a disconnect? Was it an accrual? Was it CapEx? Was it inventory? Was it intangible? It's like an orgasmic amount of data that's coming in that you're just trying to figure out what's discounted and what isn't. So to me, I think that's where the data will differentiate between all the big tech companies, and then you can also pick up other trends that are happening. Like, wait a second. So when I look recently, transportation data is really rolled over, but industrial activity looks high. That's interesting, right? I'm not paying as much now for truckloads and van loads. Okay, so that's new. The bank earnings comes in, master trust data comes in, consumer behavior comes in, consumer demand commentary comes in. Then you get the tech. Well, there's a lot of M&A happening. It seems like a lot of kind of 5, 10, 15 billion market cap software companies now look attractive to the private markets. And what's Thomas Bravo doing? Or what's these guys? Who are they buying? And wait a minute, now a bunch of companies are come down a lot. What about biotech? Is there anything coming out of the pipeline there? Because those are at an all-time low on price to sales, and maybe there's innovation on sale. There's a lot of trends that happen in every sector during earnings that I think are interesting. Healthcare services, the costs are going up. What's going on there? Because all I know is, I pay United Health 7% more every single year, no matter what happens, right? So
7, 9, and 11.
Yeah, exactly. So the single most gangster company I interact with is United Health,
which people don't realize is one of the biggest companies in the country.
Plot UNH equity GP on your Bloomberg terminal, and it's
shocking, right?
Yeah, bottom left to upper right. And one of my goals in life is to own enough UNH stock that it can offset the price increases they take on me and my employees each year to get the perfect hedge. Because door number one is, hey Adam, we're going to raise you. You pay us $20,000 now, and then we won't raise everyone in your employees for a year. And door number two is we're just going to raise all your employees. That's it. There's no three of you get a car. You get a car.
Right.
But my point is, and that's kind of joking aside, you want to look for pricing power. One of the biggest investment debates right now is which companies are going to have gross margin expansion 6 months from now, and which aren't, and is the gross margin expectation achievable or not? So you get a lot of data points on where are we with logistics, labor, wages, where are we with input costs, oil, commodities, et cetera. Who's got the pricing power? Who doesn't? I think another interesting trend in earnings, Barry, is your employee base. Is it U.S. or non-U.S.? Because most of the companies are telling you, and it's been subtle and not written about enough, that all the wage issues are in the U.S.
Yes.
Right? So maybe that U.S. non-U.S. labor mix is going to matter for your margin profile. And so to me, there's just so many things during earnings that are kind of trends that you can pick up on, and there'll be at least 10 or 12 things that happen in kind of mid-April through mid-May that update you on and increase or decrease your confidence on estimate achievability broadly, and then within each industry going forward. So when I give investment advice, a lot of it is about relative estimate achievability 6 months from now. So I think energy, okay, that's somewhat easier. The correlation between the change in the oil price and the change in the earnings of the net income of the energy sector is 0.8. So it's when oil goes higher, they're going to make more money. But there's more subtle things. We've been a little bit cautious on industrial, machinery, and capital goods because the estimates hockey stick in the second half of the year. We saw the most down revisions of any sector in the market in industrials in Q1, but the stocks didn't really underperform that much. So there seems to be this disconnect. Transportation's rolling over. So I'm trying to figure out why do I have really high incremental margin expectations embedded in the industrial sector stocks, yet there's a bit of a slowdown and margins have already recovered. So to me, those are the kind of dislocations that you should, if you're being intellectually honest, get increased or decreased conviction on during earnings.
So you mentioned intangibles. Your old shop, Morgan Stanley, has a division called Counterpoint. Michael Mauboussin's the head of research there. He did a really interesting piece on intangibles and essentially technology holdings, and how much of the investment community has undervalued intangibles like software, algorithms, brands, go down the list, copyright, patents, whatever, and that everybody's been looking at tech as overvalued for a decade. The market seems to have disagreed with that assessment. How do you view intangibles in that space?
Yeah, so that's an interesting question. I'll answer it purely quantitatively, which is identifying longs and identifying shorts use different signals. If I think about what people have been asking me the most in the last year, people will often say, hey, Barry, they'll say, I want to buy compounders. I want a business that compounds. So we did a lot of research, and we do a lot of kind of frameworks like this at Trivariate, where we'll say, okay, well, what is a compounder? Let's look at businesses with consistent gross margin expansion, consistent net income expansion, consistent earnings growth, consistent upward revisions, consistent price momentum. We'll take a bunch of signals and say which is associated with the best subsequent stock performance. And the answer was gross margin expansion. Okay, so we offer a screen, and people can buy a basket of compounders that have consistent gross margin expansion and forecasted gross margin expansion going forward. It seems really important in this regime because of inflation and what we talked about. But on the short side, it isn't margin contraction. The question people were asking me last year was the inverse of compounder was, I want to short a melting ice cube. That seems to be the cool Wall Street phrase. Well, short melting ice cubes, right? I want a long compounders and short melting ice cubes. So we did a note. What the heck is a melting ice cube? And what's interesting is that the thing that mattered the most, the two things that mattered the most were accruals, which would be disconnects between earnings and cash flow, which were driven by CapEx, inventory, or intangibles. So I'm getting to your intangible question. Or bad price momentum, meaning actually the stock was just simply bad versus its industry peers. So the short ideas were businesses with the biggest intangible accruals in the last 3 quarters that also relatively underperformed their peers. That, if you plotted that line versus the S&P, it materially lagged. And if you added on share loss and margin contraction, it didn't even help. So I think the fundamental analysts need to focus on the issue of whether the intangibles, CapEx and inventory are obviously big, but the intangibles are positive or not. My suspicion from Obison's work is that there's some alpha spread in that group.
For sure.
Yeah, and I haven't seen that work, but I know he's an incredibly smart guy. So, but I'd say, I think when I'm looking for short ideas, I would start with, do they have a high accrual and has the stock acted bad?
So you're describing hot stocks that have rolled over.
Yeah, in some ways, either hot that have rolled over, or they had a business model change where they had to increase their CapEx. They built inventory in advance of recovery. They did a deal and it's uncertain about what the intangibles they acquired are, something like that.
Really fascinating. All right, so let's jump to our favorite questions that we ask all of our guests.
Okay.
Starting with, and we talked about Netflix before. Hey, we're past 2 years. Everybody's been streaming all sorts of stuff. Tell us what's been keeping you entertained.
Oh boy, yeah, I'm probably in the bottom decile of culturally savvy people that you'll interview. I actually watched the David Rubenstein show on Bloomberg. I like that show.
That counts.
I think it's amazing.
As long as it keeps.
I think he's amazing. I think that show is incredible. We leave our TV on Bloomberg TV in our office, and when that comes.
Gets unbelievable guests.
Yeah, smart questions and incredible.
And his perspective is so unique because he's walked in their shoes. He's run a multi-billion-dollar company. Not a lot of interviewers bring that to the table.
Yeah, it's a great question. So I like that. In terms of podcasts, obviously yours is incredible, but but I think the truth is I'm more of a hodgepodge. People refer me stuff. I interviewed the Freakonomics guys before. I like them, so once in a while something that they say I think is interesting.
Dubner
and Levitt. Yeah, so they're interesting guys. So it mixed, but I'm not really a consistent guy, and I'm definitely not a streamer. But I am. If I look at the Parker household, we probably pay 12 different streaming services. So I'm a revenue source, but I'm a high return on revenue for those.
That's research, though. You gotta you can write that off.
Yeah, we got to start cutting something. Yeah, exactly.
So apparently, lots of other folks have thought the same thing, and we've seen that reflected in quite a few.
Yeah, exactly.
To say the least. Tell us about your mentors who helped shape your career.
Yeah, so at Bernstein, again, I think all of them came from Bernstein originally, honestly, so some of the original analysts there. So people who followed Bernstein in the 90s and early 2000s would know some of the minds there. But there's so many of them, but, people that I keep in touch with still, some of whom are still working on the street. So, so I'd say, probably Marty Leibowitz at Morgan Stanley, and then Lisa Shallett and Mark Mayer and Jonathan Gray, and who's deceased but was probably the greatest analyst of all time. And
really?
Yeah, existing analysts there as well. So there's just so many mentors I have, people who taught me that it's effort, it's enthusiasm, it's creativity, and it's a combination of analytics and communication. And, I can't imagine a more interesting job than, somebody told me once, you always want to be talking to people in their 30s because they're not so young that they're annoying to talk to, and they're not so old that technology and cool stuff has passed them by. And I think about the job I have now. I'm in my early 50s, and I think, I want to do this for the next 25 or 30 years. Like, I want to write interesting research, and I want to talk to smart, cool people about it. And a lot of them are in their 30s and 40s, and that'll be an amazing place to spend the rest of my life doing. So it's.
I tell you, it's 100% true. You know my shop. You know the guys in my office. Like, I am sort of between the Gen X and the Boomers. I have a foot in each camp. And the Millennials and the Gen Ys, they're absolutely cutting edge hip. They know everything that's going on. And I just want to avoid that whole okay boomer sort of thing. Right. And it's absolutely true.
Look, sometimes experience is anti-correlated with success, right? Like, you sit there, like I mentioned on Nvidia before, like I admit, I would have missed the first half of Nvidia's appreciation because I was encumbered by irrelevant knowledge.
Right. Experts are experts in the way the world used to be.
Right. And so I think, I see that all the time because a lot of people who are negative on the stock market are using Schiller PE or some Grantham view or stuff, something that was
How's
made
your
sense.
CAPE doing?
CAPE. And that made sense in the 80s, right? When 8 of the 10 biggest equities were energy and capital intensity was higher. And now you look at it and you're like, wait a minute, 45% of all companies don't even have any inventory dollars. Capital intensity is at an all-time low for small and micro cap. Like, FANG M it matters, not mobile or whatever. So it's like a totally different business. So, like, to say we're going to mean revert back to something from 40 years ago is just, you're encumbered by knowledge that's not relevant. Right. And I think the 30s and 40s crew is kind of right optimization on the curve. Mm-hmm. And so I want to be like hanging out with those people, and what better job than it would be to do what I'm doing. Yeah.
I'm trying to remember, was an Adam Smith book? It's talking about the new Adam Smith, not the original one, about all these funds that would hire young guns as traders because the guys who had the capital and the experience knew they couldn't buy the stuff the young guns were buying and would have missed the opportunity. But you need some adult supervision overseeing them. I don't remember if it was The Money Game or one of the books like that.
But that's why risk management and alpha generation are different, right? Like, the CIO's job and often is just some risk management. Like, what can I tolerate? What have I experienced before? Maybe some of these guys haven't seen a cycle. Maybe they haven't seen rates go up or stuff like that. So I need to have, some, maybe they don't realize that, following a financial crisis, you don't short highly shorted stocks because they can get squeezed or whatever. Like, stuff that, some of us were writing about way before January of 21 because we knew that was a risk because we saw that after the financial crisis, right? So I think that but you don't want to be the intractable guy who doesn't adapt, and I think these guys help you.
Yeah, 100%. You're absolutely right on that. Yeah. Let's talk about books. What are some of your favorites? What are you reading right now?
Right now, I've got 2 books on the nightstand. I've got Maria Ivanovich's book, Lessons from the Edge. So she was the U.S. ambassador to the Ukraine, had an incredibly interesting career. Her books, I'm only about halfway through it, but it's crazy. Her life is crazy. And obviously I haven't gotten to the part of the book where the Trump-induced exit happens yet, but incredible experience. I always wondered what these foreign policy people do. So
amazing stuff.
Yeah, she's incredible. And then somebody gave me the All In book by Billie Jean King, and I'm definitely going to read it. She's had an incredibly interesting life also. So I've got a stack, and I roll through. I am one of those people who, probably needs to sleep a little bit more, and so I try to read to
get drowsy, go to
sleep. A
little
melatonin, kind of.
By the way, if you like the Billie Jean King book, someone recommended the Andre Agassi book called Open, and it's absolutely fascinating.
Yeah, I read one of his originally years ago, but I didn't even know he had another one out.
Yeah, it's his it's really his life story, his biography.
Yeah.
What sort of advice would you give to a recent college grad who is interested in a career in investment, finance, becoming an analyst? What advice would you give them?
Yeah, I guess the 2 things would be, assuming that they weren't born on, third base or that they had to like organically earn it. I'd say one would be you need to differentiate your skill base, and the best way to do this is through computer science. So you need to program. All of the work we do, Barry, is in Python. All of it, you mentioned that you have some cool iMac that works, but I don't care because we only use dummy terminals. All the compute and storage is on Azure. Like, we don't really care. Your ability, like the days of reading Ks and like writing up a paragraph I don't want to say they're over, but like you can process information much more quickly with code. So like, I think you need to have computer science skills now, and I would encourage people to, get some skills in Python or R or kind of database work, because that's, I think, a growth industry, and analytics and data are being important considerations in every major industry, and I think in Wall Street in particular. So one, computer science, and two, like I've always been, and people ask me all the time, what should I do with my career? What advice do you have? And I always encourage people to get more education, because I think you can prove demographically that the distribution of people who get more education have more wealth, right, over time. And I think it's probably more differentiating. I know that if I didn't have a PhD in statistics, I wouldn't have gotten the jobs that I had at Bernstein, the promotion at Morgan Stanley, et cetera. And so for me, it's been huge. And my dad has a PhD from MIT, and he kind of told me, Adam, like, you get the PhD, and then the bear case is you're one of the most popular professors at the University of Michigan or something, like so like that's the bear case, and that's a pretty darn good bear case. Yeah. So I encourage the young guys every time, get more education, statistics, data science, computer science, something that is a differentiating skill, because just being like a basic MBA who's like, I like to pick stocks and I can read K's and Q's, like I don't think that's as a differentiating of a skill. And so I think if you can process information and then there's a bit of a, I should look it up, but how many people get a PhD in statistics every year in the country? There's a couple hundred, a few hundred. So it's not
That's
like,
all it is. That's amazing. I would imagine it's much more.
I mean, every major department has a few each year, right? So I don't do the math. If there's 100 real departments, there's a few each year. 500. It's not.
If only I had access to a statistician.
Yeah, you do. We'll sell you our research at no problem.
And our final question: what do you know about the world of investing today that you wish you knew 30 or so years ago when you were first getting started? Yeah.
Oh man. So much, right? Because I published 2 pieces of research for 18 years, and we've started studying and learned a lot. But I guess holistically, I'd say it's a very competitive business with a lot of incredibly smart people, and it's very humbling. So this idea that you're used to being smarter than people because you got an A in math in high school and you're the smartest kid in your class, like everybody's smart and everybody works hard, and so you have to have a differentiated way of thinking about the world, I think. So I could have picked an easier industry to compete in for sure.
To say the very least.
Yeah.
Adam, thank you for being so generous with your time. This really has been a lot of fun. We have been speaking with Adam Parker. He is the founder and CEO of Trivariate Research. If you enjoy this conversation, well, be sure and check out any of the previous 400 or so we've done over the past 8 years. You can find them wherever you get your podcasts. We love your feedback and suggestions. Write us at mibpodcast@bloomberg.net. You can follow me on Twitter at Ritholtz. Sign up for my daily reads at Ritholtz.com. I would be remiss if I did not thank the crack team that helps us put these conversations together each week. Mohammed Rumawi is my audio engineer. Paris Wald is my producer. Sean Russo is my director of research. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.